This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, it's a government shocking directive as they order the banks to do the unthinkable. And I want you to understand this is something the banks do not want to do at all. And so we need to take a look at what's going on inside the banks right now that's driving their decisions and why the government is trying to force their hands and put the banks at extreme levels of risk. And we're also in Texas today as many investors believe oil prices are only going to scream higher. We've got new evidence that suggests oil prices and inflation are going to come crashing down. Now let's head over to Bloomberg where we picked today's story up. I want to start here with what's going on with China's mega banks because they're posting a rare profit drop on margin squeeze. And this is a big issue that we're going to see not just inside Chinese banks, but all around the world. And how governments react to this is going to be very interesting because the same issues, again, are showing up all over the world. And here we can see ICBC and Agricultural Bank of China, which said profit fell 1.6% last reported declines in the fourth quarter of 2022. It's the first quarter earnings drop since they became publicly traded in Hong Kong more than a decade ago, a period usually marked by a surge in lending. So there's the first indicator that we're seeing a decline in lending. Now, part of that is due to the fact that the global economy is slowing down. The other factor here is that consumers lack confidence in the economy. When people feel confident and businesses feel confident, they borrow money, they expand their businesses, they buy things they'd like to have today, knowing they can make the payments on the loan very easily. But now all of a sudden we're seeing a shift in a big decline in lending, and some of this driven by higher interest rates as well as consumers reject higher rates and higher loan payments. But this time results were pummeled by a combination of weak loan growth, margin contraction, and lower fee income. And this is critical because we're seeing the debt-based system now that needs a constant expansion of debt. Here we're seeing in China weak loan growth, but it's not just in China this is showing up. It's showing up here in the United States, it's showing up in Europe, it's showing up all over the world that the banks are seeing a big decline in demand, and that is not good for the system at all. As Chinese lenders are in the midst of a prolonged squeeze that has narrowed margins to record lows. As Beijing has over the past few years called for the banks to cut loan rates, you gotta love that, telling them to cut what their interest rates are and beef up lending to support areas including its cash-strapped property sector and local governments. And that is a big issue as Beijing looks to drive demand and says, wait a minute, we're seeing an issue here. It's all about the banks. If they could just cut their lending rate and put more money out in the economy, everything would be fine. But it starts to come back to central bank policy and government policies where the banks are in a position now they don't want to lend. They want to do other things, which is going to make it even more interesting when I show you what Beijing is threatening the banks with and wants them to do now. And here you can see the Chinese banks' net interest margins have hit a record low at the end of 2023. And what net interest margin is simply what the banks make after they go out and lend and pay depositors. It's what's left. And as you can see based on the chart, it's falling in a big way. But one thing that shouldn't be getting squeezed, well, that's your trading and investment account. Look at this. As the close of April 26th, this was Friday. This was a big trade we put out to our subscribers. Some of them even emailed me, said, Steve, when this first trade came on, there's like no way this is going to play out. Sure enough, look, while the markets were coming down, this trade went on the books at 314. It's now up 13.59%. This was generated by our CTA Timer Pro report. Our Momentum Timer Pro report triggered it twice, both on March 13th and 19th. Trades are up over 12 and 11% respectively as on Friday. And how can you make a big difference in your trading and investment accounts? Well, we give you the tools to not only make money trading, but to make money and protect your money investing. How do we do that? We have two wonderful reports. One of them is called CTA Timer Pro. This looks at how the machines look at the market and we mimic it, but we do a historical overlay that they don't even do. So when they're in deep short positions, we tell you when they're about to cover and when you buy in. What's the key to success? You want to buy before the machines do. and get out before they sell. Now, if you're a technical trader, you've been frustrated because you know you're coming in late into positions, getting out early, they jump all around. Our Momentum Time Pro takes all those things like the RSI and the MACD and all those other signals, smooths them out, adds a proprietary overlay. We give you the signals, and here's the best part, we give you videos on how to do the trades when they come out. And unlike my competitors who can make you pay 50% for their first month, we give it to you free because you know we'll make you more money than they will. Check it out because you shouldn't have to deal with the margin squeeze that they're going to put on as China's home sales now slump dragged on in March. And this is an issue. We continue to see evidence the global economy is slowing, the Chinese economy is slowing, the housing market is slowing, while home price declines deepen from a year earlier for both new and used homes, signaling a much hoped turnaround for the sector that isn't in sight yet. And many people say this is not going to happen in the United States. Well, it's coming. I want you to understand that gradual contractions of credit do eventually lead to a decline in price and even interest rates, as we'll show you here in a bit. The government may press state banks to continue cutting lending rates, further eroding their margins and making it difficult to grow profits. But that is not the issue that the Chinese banks are facing because Beijing is now ordering them to do the unthinkable. And when we think about the U.S. and we look back to the pandemic, what happened with the banks here? Well, they were ordered to do something too, and that was lend. As the PBOC expands warning on bond investments to regional banks, this is a shocking move because what's happening here is Beijing is ordering the banks to deal with their bond holdings. Check this out, as China's central banks has advised some regional lenders to curtail their ultra-long bond investments to mitigate risk. Now, this doesn't make any sense. Now, why would the central bank come out and tell the banks, hey, you're managing your risk, so we want you to curtail your investment of the long bond? Now, it doesn't make a lot of sense here unless rates are going higher, but we know the PBOC is signaling the rates need to come down, as city and rural commercial banks in at least 2 eastern provinces were instructed in recent weeks to avoid significant exposure to these securities. That is significant, and under guidance from local branches of the PBOC, regional banks have also been asked to reduce duration and leverage on bond holdings. And this is an outright baffling move. And why is that happening? Well, let's talk about how the banks function. When they get a deposit, they have to back it with an asset. Now, ideally, that asset is a loan. So they lend the money out and they generate a premium on the interest on the loan, and then they make money off the spread of what they pay the depositor. Now, when you don't have enough new loans to come in on your books, well, you still have to buy an asset because you still have to pay interest to your depositors. So you go out and you buy government securities. We see the same thing that happens in the U.S. banking system here. And now let's take a look at why. Because PBOC has stepped up efforts to cool the rally in long-term sovereign bonds. And that is interesting because that means rates are going down, signaling intentions to correct any mismatch between market prices and economic outlook. Now, this is fascinating because long-term bonds signal growth and inflation expectations. So when you see interest rates on the long end of the curve, we're talking here on the US, say 10, 20, 30-year bonds, when you see interest rates decline, it means growth and inflation expectations are coming down. Now, the PBOC is seeing this and saying, wait a minute, this is a huge problem because we need to see our economy grow, and if interest rates are being driven down, which they think is by the banks, it's not, it's by the system itself saying we have a problem here. Well, that means you tell the banks to stop buying the long bond and cut their duration down to drive long-term rates up. And the latest directive follows similar guidance to rural lenders earlier this month to cap their exposure to ultra-long debts. And here you can see China's 10-year sovereign debt yield rises to a 2-month high based on, of course, that threat by the PBOC. You need to cut your exposure, and rates went up. But notably, you see rates have been coming down. And again, what do we see in the Chinese economy? The growth and inflation expectations are indeed slowing down. The bond market is just reflecting that. So this little blip here, we see higher in yields based on the PBOC's threat. Well, look for it to reverse in the near term, as investors have been drawn to sovereign notes this year, betting that the central bank will ease monetary policy to support an economy grappling with sluggish demand and a property crisis. So when we talk about growth and inflation expectation, there it is. Demand is falling. We already know producer prices in China are negative, and the CBI as well, somewhere near zero. As China's credit growth continued to slow in March and banks extended fewer loans than expected. And this is something that happens in a debt-based economy when central bankers raise rates higher than the market wants. When they actually artificially raise them above demand, what happens is you see slowing loan growth. This is no different than any business that raises prices on a product until a point where people don't want to buy it. The same effect happens here in the banks. The PBOC's maintaining of an easy liquidity condition has provided traders with more funds to allocate to bonds, and China's local credit yields have fallen to the lowest level as investors snap up corporate bonds as well. And all of this suggests here is that the bond market there is indeed reflecting that growth and inflation expectations are falling. This is not what the PBOC wants to see, because it's telling them that what their policies are not working at all. And in the meantime, many people think that U.S. rates need to keep going higher. Hang tight. We'll take a look at that in a moment, as bonds have also benefited from large purchases by wealth management funds and haven demand from local institutions. The yield on 30-year debts has been declining for 4 straight quarters and is hovering near a 20-year low amid insufficient credit demand. There's a key word, an abundant liquidity. Now, I want you to be thinking now about what's happening here in the U.S. We have the opposite effect. Investors think that rates need to go higher, higher, and higher. The Fed keeps saying, well, we need to keep them elevated, and we'll hear from them this week on what their stance is. We'll note that they're unlikely to raise rates here. They may threaten to raise them in the future, but when we look at lending demand, and this is critical to understand, if rates keep going up and lending demand falls, well, that means you're going to drive the economy into a recession or a financial crisis. And what happens at some point, rates will start to fall to spur credit demand. And this is key. The system will, all of a sudden, you'll see rates just start to tumble down. And let's take a look at the evidence here, because again, in a debt-based economy, you need an expansion of debt, a constant expansion of debt, to not only hit your growth targets, but to pay on the existing debt. And you can look here as we look at the commercial industrial lending data that's shown in blue. This is a weekly data shown on a year-over-year rate of change against 10-year treasury yields. Now, this is the U.S. data. So when we see a deceleration in lending, what happens? Rates come down, and you see it happen over and over and over again throughout history, even in times when lending demand appears to be fairly hot because it's not keeping the economy sustained. The rates come down to spur lending growth. In that case, it came crashing down and then it took off. Here we see one of the few times that lending demand is in contraction. That means on net, the banking system here is destroying money, and yet the market believes that rates need to go ever and ever higher. What's going to happen is at some point, the banks are going to be in dire shape. We're going to see more of them fail because they lack, of course, the ability to lend at these higher rates. And in turn, they're going to have to buy even more and more bonds, driving rates down, putting pressure on the Fed to cut rates until eventually either we have a massive recession or the system it comes into equilibrium. The reality is, at this stage, it's too late. The Fed's gone too far. And we can see that here in the currency markets as Japan finally intervenes after yen slides against the dollar. This is bad news for, of course, what's going on in Japan. They don't want to see the yen have to fall like this and intervene. As the yen weakened to around 160 per dollar on Monday, but bounced back to around 155 per dollar after Japanese authorities started buying yen and selling dollars. Now, this is interesting because when you see, of course, lending demand contract, it destroys money. So the system needs dollars. Here, Japan's just going to feed it some, but it won't make much of a difference because they don't have an unlimited source of dollars to sell here. As Japanese officials didn't officially confirm the move, but we see the finance ministry's top currency official hinted at the intervention. It's difficult to ignore the bad effects of these violent and abnormal movements this in currencies will cause the nation's economy. This is true. If you see big moves in currency, it means bad things for your economy, and the government will continue to respond to wild currency moves. That is interesting now that we know they're going to further intervene here. We see this in the currency markets, and of course, those subscribe to our reports. they are noticing a lot of momentum shifted recently on a bunch of currencies against the dollar, and they're taking advantage of that, and you can too. Links in the description below, as it's unlikely to be the last time Japan intervenes in the currency market this year. Well, that's a given, especially since U.S. interest rates are likely to remain high. We'll find out more on that this week from the Fed. And here we can note that why, of course, we're going to see continued upward pressure on the dollar has everything to do with the lending market. We come back to that commercial industrial lending data, and we'll note that dollars are created when commercial banks lend. They're destroyed when it goes into contraction, contraction being any period under this horizontal black line. So you see these decelerations, it usually is matched by an increasing dollar. And that happens more times than not. You see here a deceleration lending, the dollar rallies, a long deceleration of lending, the dollar rallies. Why is that? Because there's a demand for dollars and the system isn't creating enough, and that means the value of the dollar goes higher and eventually sends the U.S. economy in the wrong direction. And right now we see lending in contraction. That's going to put further upward pressure on the dollar until, of course, again, the U.S. economy slows down. But are we seeing evidence of that? Well, the Fed says they need to see inflation come down. Or for that to happen, oil prices do. But with what's going on in Texas, we now have some early signs that indeed oil prices are coming down. As Texas manufacturing sector indicates mixed in April, as factory output strengthened slightly in April, according to business executives. The production index, notably, we'll show you the rest of the report, but they're focusing on the one part that went good. A key measure in state manufacturing rose from contraction at minus 4.1 into the green at 4.8. But look at this. Other measures of manufacturing activity were mixed this month as new orders remain negative, and that's a problem, as I'll show you, for oil prices, though it pushed up 7 points to minus 5.3. Capacity utilization and shipments turned positive, showing a little bit bigger boost in activity, but new orders still remain negative. And perceptions of broader business conditions continued to weaken in April as a general business activity held steady in contraction at minus 14.5, signaling worsening activity. This is not good at all. But let's look at this chart here, because when we look at the current new orders, this is the diffusion index for Texas manufacturing against crude oil, and what you can see is there's a beautiful relationship between the two. And the recent rise in oil prices had to do with the fact that new order demand was rising in Texas. So now we're starting to see that new order demand remains in contraction here. The question is, will it roll over and head down? If it does, that means a big plunge in oil prices will likely follow here. That means inflation comes down, the Fed gets to cut, Japan gets happy, and well, so do a lot of other central bankers. But look at this, and here's the evidence that new orders are going to decline. Labor market measures suggested flat employment. If you're seeing demand, well, that means you hire, and slightly shorter work weeks. So again, we talk about the first step is cutting the work weeks, then you cut heads. That's not a good sign here, as the employment index edged down to a near zero reading, suggesting no change in employment. 15% of firms noted net hiring, the same as a share noting net layoffs. The hours worked index remained negative for the 7th month in a row, and that is indeed a problem here. And we can see from the computer and electronic manufacturing, we're close to an inflection point of a cyclical bottom. Customers have been reducing inventory, and that looks to be coming to an end, and hopefully means demand goes up. But here we see business has not been this slow since COVID, and I'm worried. Customer orders have dropped. Businesses is generally good, but we're starting to see more customer resistance to prices that we know when they reject higher prices, well, demand goes down. How about this? Business and political environment is terrible. Consumer confidence for consumer goods has noticeably worsened. So while there's hope that new orders will go up, the reality is consumers can't afford these higher prices. The banks aren't lending. We're seeing them in contraction. It's destroying money. We're setting all of the things we need to see now to head into a recession. That means rates likely to come down, oil prices to come down, and banks, well, unfortunately, not just in China, but here in the U.S. and other parts of the world, more of them are going to fail. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.